Hello students, welcome to EPG Pathshala. I am Dr. Vishal from Maharaja Agarsen University, Badi, Himachal Pradesh. Today we are going to discuss about the module International Financial Markets 1 under the paper International Business Operations. Students, after completing this module, you will be able to understand the meaning of international financial markets, understand the types of international financial markets, and also know about the participants in international financial markets. The international financial market is a worldwide marketplace in which buyers and sellers trade financial assets such as stocks, bonds, currencies, commodities, and derivatives across national borders. Over recent decades, there has been a steady increase in cross border financial flows around the globe. There are two main reasons for the integration of markets. First, various financial institutions, including banks and institutional investors, have expanded their activities geographically. In this process, they acted as an intermediary to channel funds from lenders to borrowers across national borders. Second, the more mature security market have gained a clear cross-border orientation. In many instances, newly issued securities are designed and offered to the public in such a way as to maximize their appeal to the international investors. These developments reflected the progressive dismantling of controls on cross-border financial flows as well as the liberalization of national financial markets more generally. Technological advancement and financial innovation played a key role in developing globalization of financial markets for the last 2 decades. Information systems have become able to compute and store more data. Telecommunications networks have extended their ramifications and increased their capacity, while more reliable data exchange protocols have made it possible to connect computing machines in more efficient ways. As a result, cross-border financial deals have become easier and more secure. Moreover, over the last 2 decades, more innovative financial products are evolved in the financial market called as derivative instruments. These products make it possible for borrowers and lenders to customize their risk exposures as well as adjust them over time. With derivative products, borrowers and lenders can therefore customize their contracts and hedge their risk by entering into a legally binding contract. Derivatives provide an effective solution to the problem of risk caused by uncertainty and volatility in underlying asset. Types of international financial markets. International financial markets can be classified as foreign exchange market. Foreign exchange is a market where participants buy and sell foreign currencies. That is, in this market, one currency is exchanged for other currency. The foreign exchange market, popularly known as forex or currency market, is a worldwide decentralized over-the-counter financial market for the trading of currencies. Financial centers around the world function as anchors of trading between a wide range of different types of buyers and sellers around the clock. With the exception of weekends, the foreign exchange market determines the relative values of different currencies. The primary purpose of the foreign exchange market is to assist international trade and investment by allowing businesses to convert one currency to another currency. For example, it permits a US business to import British goods and pay pound sterling, even though the business income is in US dollars. It also supports speculation and facilitates the carry trade, in which investors borrow low yielding currencies and lend or invest in high yielding currencies, and which it has been claimed may lead to loss of competitiveness in some countries. In a typical foreign exchange transaction, a party purchases a quantity of one currency by paying a quantity of another currency. The modern foreign exchange market started forming during the 1970s when countries gradually switched to floating exchange rates from the previous exchange rate regime, which remained fixed as per the Bretton Woods system. The foreign exchange market is unique because of its following features: huge trade volume leading to high liquidity, geographical dispersion, continuous operation 24 hours a day except weekends, the variety of factors that affect exchange rates, the low margins of relative profit compared with other markets of fixed income, the use of leverage to enhance profit margins with respect to account size. Option market. Option market is a market where option contracts are traded. Option is a contract for the future delivery of a specific financial asset in exchange for another, in which the option holder has the right to buy or sell the financial asset at an agreed price or exercise price or strike price, but is not required to do so. The right to buy is a call option and right to sell is a put option. For such a right, the option buyer pays the amount called as option premium. The option seller receives the premium and is obliged to make or take the delivery at an agreed upon price if the buyer exercises his option. There are two types of option contracts: American option and European option. American option are the contracts in which the buyer of the option has the right to exercise his option at any time before the maturity date of the contract. On the other hand, European option are the contracts in which the buyer of the option can only exercise his option on the maturity date of the contract. There are two types of option markets: organized exchange and over-the-counter market. Exchange traded options are standardized contracts with predetermined prices, standard maturity period, with fixed maturity months. The a standard quantity of a specific financial asset on a future date at a specific price agreed upon between the parties through a transaction on the floor of organized future exchange. It is an organized market where contracts are undertaken by the parties for the future commitment of prices. It is an organized market where a recognized exchange is involved for the future delivery. Moreover, future contracts are standardized contracts which must be settled through a clearing house of the stock exchange. These contracts are adjusted through daily mark to market base, which is also called as M2M. Euro currency market. Euro refers to the funds outside the country of the currency in which these funds are denominated. Euro currency market is a market where Euro bank accept deposits and make loan which are essentially denominated in a currency other than the currency of the country where the Euro banks are located. For example, euro dollars are dollar denominated deposits in the banks outside the United States. Usually, euro currency market includes all euro currency liabilities, interbank deposits, and transactions between eurobond and non-bank users. But in its actual sense, it includes only those deposits and loans which take place between euro banks and non-bankers. Initially, euro currency market was originated as dollar denominated euro deposits and euro loans. But now it is not confined only to euro dollar market. So many other currencies have taken the form of euro currency. Euro market includes both capital market and money market. Euro banking involves attracting funds from non-residents and making loans to other non-residents. Initially, it was confined only to dollar deposits and loans, but now it has taken to many shapes, that is GDRs, ADRs, FRNs, EMTNs, FRCDs, ECPs, EBs, and so many other instruments used in the international markets. Euro market continued to grow by attracting both borrowers and depositors by offering much better rates as compared to domestic market. So many countries have eased exchange controls and also encouraged offshore banking. Funds have found their way into euro currency arena. As a result, the size of the euro market is growing day by day. In case of currencies which are relatively free convertible into other currencies, deep euro market exists. Euro banks are generally located in those centers that refrain from regulating foreign currency banking activities. Though so many currencies have entered in euro market, yet euro dollar market remains major players in euro currency market. London is a main center of euro currency. Participants in financial markets. Borrowers or issuers, lenders or investors, and intermediaries are the major players of the international markets. The role of these players is discussed as below. These are primarily corporates, banks, financial institutions, government and quasi-government bodies, and supranational organizations which need forex funds for various reasons. The important reasons for corporate borrowings are need for foreign currencies for operation in markets abroad, duly saturated domestic market, and expansion of operations into other countries. Governments borrow in the global financial markets for adjusting the balance of payments mismatches, to gain net capital investments abroad, and to keep a sufficient inventory of foreign currency reserves for contingencies like supporting the domestic currency against speculative pressures. Further, the supranational organizations like the International Monetary Fund, World Bank, International Finance Corporation, Asian Development Bank, etc., borrow usually long term funds to finance diversified financing, sometimes linked to swaps for hedging current or interest rate exposures. These supranational are also typical examples of large entities appearing in the global markets as both issuers and borrowers. Lenders or investors. In case of euro loans, the lenders are mainly banks who possess inherent confidence on the credibility of the borrowing corporate or any other entity mentioned above. In case of GDR, it is the institutional investors and high net worth individuals who subscribe to the equity of the corporates. For an ADR, it is the institutional investor or the individual investor through the qualified institutional buyer who puts in the money in the instrument depending upon the statutory status attributed to the ADR as per the statutory requirements of the land. Investors in the global markets come in a large range who invest to suit their own requirements, investment objective, risk taking abilities, and liabilities. The investor range includes private individuals investing through Swiss banks, the IMF, and the World Bank. The other major investors are insurance companies, professional fund managers, and investment trusts. In the United Kingdom, with London still a major force in the international finance market, it is the pension fund and insurance companies which are the major investors in the equity markets and bond markets. In the USA and Japan, the private players has an important role in the equity markets. In Germany, on the other hand, commercial banks play a dominant role as investor. Speculators. Speculators are type of investors who take higher than the average risk, seeking for abnormal profits as they are mainly concerned about speculating which might be the futuristic prices of certain asset. For example, currency or a commodity. Mainly, they are involved in buying and selling future and option contracts in the short term as they represent almost 70% of investors, which might be known by risk seekers. Hedgers. Hedgers are type of investors who try to avoid or cancel any risk that can be accompanied with certain investment. They try to take positions that might prevent them from any potential losses. These types of investors are widely found in markets that are full of uncertainties and high volatility. There are many types of hedging positions like natural hedges, hedging credit risk, hedging currency risk, hedging equity, and equity futures, which are also known by risk neutrals. Arbitragers. Arbitragers are types of investors who buy securities in one market then immediately resell it in another market in order to profit from prices divergence, as this type of dealing is only suggested only for well experienced investors, as any delay in transactions could result of huge losses. The effect of these transactions would result in adjusting price differences between markets. Intermediaries. There are a number of market intermediaries known as financial intermediaries or merchant bankers operating in financial system. These are also known as investment managers or investment bankers. The objective of these intermediaries is to smoothen the process of investment and to establish a link between the investors and the users of funds. Corporations and governments do not market their securities directly to the investors. Instead, they hire the services of the market intermediaries to represent them to the investors. Investors, particularly small investors, find it difficult to make direct investment. A small investor desiring to invest may not find a willing and desirable borrower. He may not be able to diversify across borrowers to reduce risk. He may not be equipped to assess and monitor the credit risk of borrowers. Market intermediaries help investors to select investments by providing investment consultancy, market analysis, and credit rating of investment instruments. In order to operate in secondary market, the investors have to transact through share brokers. Mutual funds and investment companies pool the funds of investors and invest the corpus in different investment alternatives. These market intermediaries provide different types of financial services to the investors. They provide expertise to the securities issuers. They are constantly operating in the financial market. Small investors, in particular, and other investors too, rely on them. It is in their own interest to behave rationally, maintain integrity, and to protect and maintain reputation, otherwise, the investors would not be trusting them next time. In principle, these intermediaries bring efficiency to corporate fundraising by developing expertise in pricing new issues and marketing them to the investors. Some of these are discussed as follows. Lead managers. The responsibilities of a lead manager include undertaking due diligence and preparing the offer circular, marketing the issues, including arranging the roadshows. Lead manager, sometimes in consultation with the issuer, can choose to invite a syndicate of investment banks to buy some of the bonds or depository receipts and help sell the remainder to other investors. Co-managers are thus invited to join the deal, each of whom agrees to take a substantial portion of the issues to sell to their investor clients. Quite often, there will be more than one lead manager, as mandates are sometimes jointly won, or the investment bank, which actually won the mandate from the issuer, may decide that it needs another institution or to ensure a successful launch. Two or more managers may also reflect the fact that a geographical spread of placing power is required or deemed appropriate. One of the lead manager will run the books for the issue. This essentially involves arranging the whole issues, sending out invitation telexes, allotting bonds or depository receipts, etc. Underwriters. The lead managers and co-managers act as underwriters for the issue, taking on the risk of interest rates or markets moving against them before they have placed bonds or depository receipts. Lead managers may also invite additional investment banks to act as sub-underwriters, thus forming a larger underwriting group. A third group of investment banks may also be invited to join the issue as members of selling group, but these institutions only receive a commission in respect of any bond or DRs sold and do not act as underwriters. The co-managers and the underwriters are also members of the selling group. Agents and trustees. These intermediaries are involved in the issue of bonds or convertibles. The issuer of bond or convertibles, in association with the lead manager, must appoint paying agents in different financial centers who will arrange for the payment of interest and principal due to investors under the terms of the issue. These paying agents will be banks, lawyers, and auditors. The lead manager will appoint a prominent firm of solicitors to draw up documentation evidencing bond or DR's issue. The various draft documents will be scrutinized by lawyers acting for the issuer and in due course by the co-managers and any other party signing a document related to the issue. Many of these documents are prepared in standard forms, but each needs to be reviewed carefully to ensure that all parties to the transactions are fully satisfied with the wording. The issuer will also appoint legal advisors to seek advice on matters pertaining to Indian or English or American law and to commit on necessary legal documentation. Auditors or reporting accountants will become involved as well, supplying financial information, summaries, and an audit report which will be incorporated into the offering circular. The auditors provide comfort letters to the lead manager on the financial health of the issuer. Further, they also provide a statement of difference between the UK and Indian GAAP in the case of GDR issue. Listing agents and stock exchanges. The listing agent facilitates the documentation and listing process for listing on stock exchanges and keeps on file information regarding the issuer such as annual reports, articles of association, the depository agreement, etc. Depository bank. Depository bank is involved only in the issue of DRs. It is responsible for issuing the actual DRs, disseminating information from the issuer to the DR holders, paying any dividends or other distributions, and facilitating the exchange of DRs into underlying shares when presented for redemption. Custodian. The custodian holds the shares underlying DRs on behalf of the depository and is responsible for collecting rupee dividends on the underlying shares and repatriation of the same to the depository in the US dollars or foreign currency. Printers. The printers are responsible for printing and delivery of the preliminary and final offering circulars as well as the DR or bond certificates. So students, let's now summarize what we have learned in this module. In this module, we have learned about the concept of international financial markets, the reasons for its growth, various types of international financial market, and the participants of financial markets. As we have discussed in the beginning of the module, that there has been a steady increase in cross-border financial flows around the world over the last few years. There are two main reasons for this financial flow. First, various financial institutions, including banks and institutional investors, have expanded their activities geographically. In this process, they acted as an intermediary to channel funds from lenders to borrowers across national boundaries. Second, the more mature securities market have gained a clear cross-border orientation. Technological advancement and financial innovation played a key role in developing globalization of financial markets for the last 2 decades. The advancement in ICT leads to the development of more innovative financial products in the financial market called as derivative instruments. These products make it possible for borrowers and lenders to customize their risk exposures as well as adjust them over time. Thank you.